Thursday, February 13th, 2020, Monaco 64, home of alternative economics and contrarian views. So the bond yield meltdown is resuming or continuing in Europe, especially in Europe, of course. Last year, the amount of negative yielding bonds reached over $17 trillion. And what are negative yielding bonds? Why would people buy that? Well, basically, let's say you buy a 10-year bond for 102, and then at maturity you get 100 back, so you lose $2 or €2. Those are negative yielding bonds. And why would investors buy them? Well, because bond prices move inversely to the yield, and so if the yield is going down, prices are going up, and so it's like your principal increases, capital appreciates. The other thing that's happening, of course, is the negative interest rates that the ECB has been setting for the short-term rates. It makes it silly to keep cash in the bank if you're paying like 0.8% to the bank. A couple of days ago, I made a video talking about how the euro is sinking to new lows versus gold as negative yields take their toll. I talked about how Citibank is charging euro balances almost 1% a year. So what's been happening the last few years is that instead of keeping their money in the bank, investors are buying these government bonds. They started out with the better quality bonds like the German ones, but what that has done is driven their yields lower into negative territory. And I want to look at an article here which is amazing. It wouldn't have happened in a normal free market. This is all happening because I would say the poster child for this, of course, is Ben Bernanke with his helicopter speech, quantitative easing, but also Mario Draghi of the ECB back in 2012 when the whole sovereign debt crisis was unraveling and governments were going to go under in Europe, especially the southern European governments like Italy, Spain, Portugal, Greece. So what Mario Draghi did then was he was going to do everything it took to save the euro, to save these governments. So he started massive money printing, bailed out basically through the back door all these governments. He got speculators on his side to drive bond yields lower, prices higher. He's created this bubble. My advice I have for Mario Draghi is to try to get as far away from Rome as possible, because when this bond bubble that he's been instrumental in creating, when it blows, there's going to be a lot of anger, and I'm not sure he's going to get away with it. I was looking at the antipodal point of Rome, which means the farthest away point from Rome, the opposite of where Rome is on the map, and that is in the South Pacific, and the closest city to that point is Waitangi, New Zealand. So Mr. Draghi, if I were you, I'd think about moving to Waitangi, New Zealand before, you know, the proverbial hits the fan. Anyway, there's an interesting article here because I was talking about the Greek government bonds 2 days ago in my video about the euro. So FT's come out. Greek 10-year bond yields fall below 1% for first time. And I'll go through this article. There's a very interesting comment below from a hedge fund or an asset manager, and I want you to pay attention to that. Country's borrowing costs hit record low as economic recovery takes hold. This is by Tommy Stubbington from yesterday. Greece's spectacular bond rally reached another landmark on Wednesday as the country's 10-year yield dropped below 1% for the first time. So let's see where we are right now. That's continued to go lower. Right now, it's dropped another 10 basis points and it's at 0.9. That's the 10-year yield for Greece. Right now, the US is paying 159 to borrow. Does that make sense? Greek borrowing costs have tumbled to record lows this year in defiance of its junk credit rating as investors pile into corners of the eurozone, that market that offer a positive yield. So this is all because of the ECB with their negative interest rates that they've set for the base rate. Banks now are charging their customers to keep balances in the bank. So they've gone out and bought all these government papers and now they're going towards the junk end of the European government bond spectrum into Greece. The recent drop in borrowing costs caps a dramatic turnaround since the height of the eurozone debt crisis, when the country's 10-year yield, wait for this, spiked above 30%. So from 30% to 90 basis points. It's quite amazing. Effectively locking it out of the market. Athens last month attracted bumper demand for a sale of new 15-year bonds, its longest dated debt since a series of bailouts and debt restructuring 8 years ago. There was a wall of money out there chasing these yields, said Antoine Bouvet, a senior rates strategist at Dutch bank ING. Mr. Bouvet said investors were betting the European Central Bank would stick with sub-zero interest rates, there you go, for an extended period, adding that the appeal of such markets as Greece and Italy that offer extra yields above the Eurozone's safest bonds. Furthermore, the Greek economy is experiencing solid growth at a time when much of the Eurozone is slowing, while the election of a business-friendly government in 2019 under Prime Minister Kyriakos Mitsotakis has further bolstered confidence. Despite overall debt of more than 180% of its GDP, much of the money Greece owes is in the form of long-term, low-interest rate loans from bailout creditors. The government has enough cash to meet its funding needs this year, according to officials. That gives investors confidence that there isn't a massive flood of bond issuance on the way, Mr. Bouvet added. And this is an interesting part here that we're coming to, that you need to keep in mind here in terms of front running or people buying these bonds before index funds get involved. Fitch Ratings last month lifted Greece's credit rating to BB, 2 notches below the investment grade status that would qualify its debt for global bond indices and for purchases under the ECB's quantitative easing program. This is the interesting part here. The trajectory will be for further upgrades and a first investment grade rating, perhaps by the end of next year, said Mark Dowding, Chief Investment Officer of Blue Bay Asset Management, basically a hedge fund. And he says, there's an opportunity for an active manager like us because index trackers will be obliged to buy bonds off us no matter how ridiculous the price. So here is Mr. Dowding saying that the prices are going to get ridiculous, and that's not going to stop the bond managers for index trackers from buying them, because they're forced to. So I think that's quite irresponsible, and a lot of the pension funds track these bonds. They put a lot of money into bond funds. So this is fine right now, but eventually when the bond bubble pops, it's going to be a complete disaster. hopefully, Mr. Draghi, and hopefully, Mr. Draghi, you'll be in Waitangi, New Zealand by that time. Mr. Dowding said he expected Greek yields to fall further this year as investors looked for alternatives to the negative yields offered by the bonds of countries such as Germany, France, and others, I would say. The yield for German bonds and French OATs have sunk further this year as fears over the spread of coronavirus fueled demand for haven assets. Markets are no longer pricing in rate increases from the ECB next year due to the economic impact of the virus outbreak. I'm not sure I buy into the reason why they won't raise rates, maybe partly, but I don't think they can ever normalize ever again. So it's going to be the biggest bond bubble ever. It's going to be the biggest burst ever, and it's going to be devastating for millions of people, unfortunately. To finish off, I want to let you know what the number is right now for negative yielding bonds in the world. I don't have a Bloomberg terminal. I used to when I worked in the city. It costs about $2,000 a month to have one, but thankfully I have a friend who still works in the city and he gave me the number today. There's an index that Bloomberg tracks. It's a BNY DMVU index, and it tracks the amount of negative yielding bonds in the world. And as of this morning, a couple of hours ago when my friend called me, we were at 13.16 trillion. So how does that compare with the past? I found an article on Bloomberg where they've written about this, so I've got some illustration. Back in December of 2018, we were at 8.3 trillion. Asia was just under 5 trillion. Europe at 3.2 trillion. America's only 40 billion. Others, 246 billion. So the peak was in August last year. My friend told me that the number was 17.6 trillion as of August last year. Bloomberg, in their article, have 16.8 trillion, so it's fairly close as of August 2019, so I'd say 17 trillion. Notice how Europe had caught up and gone past Asia, 8.6 to 7.3, but look at the Americas, from 40 billion to 336. So that's a big move. I think it's inevitable. It's only a matter of time until negative rates come to not only the UK, but probably in the US as well. It will give the Fed no choice but to cut rates, the short-term rates. So where were we at the end of last year? Because right now we were at 13.16 trillion. As you can see here, December 2019, we dropped to 11.2 trillion. It looked like things had stabilized, but it's not. We're seeing that rush to yields. It's a sign that the economies are going to continue not to do well, and that the central banks are going to continue to print money. So we were at 11.2 trillion. The Americas had dropped back to 186 billion. Europe had dropped back to 5.8 trillion. I don't have the specific continents, the amount for each specific continent, but I can tell you that we've increased by almost 2 trillion, just under 2 trillion in 6 weeks. So yes, a lot of people are gonna blame what's happening in China for this. It's partly true. It could be the trigger for it. But if we hadn't had these crazy monetary experiments from the central banks, we wouldn't be in this situation of negative yielding bonds. And it's even worse if you account for what they call inflation, which again is not real inflation. It's the CPI, it's the measure of prices. I think inflation's a lot higher. For example, in France, I think the harmonized CPI is 1.7%. So you add the negative rates that investors are getting, Is it any wonder that gold is making new highs again today versus the euro? And will keep making new highs against all the other fiat currencies. The central banks have no choice. If they raise interest rates, they pop the bubble. So they're damned if they do, and they're damned if they don't. They're just buying time. Eventually, this bond bubble will blow up. Prices will go to astronomical or ridiculous levels, as that hedge fund manager said in that article. And then they will just implode the prices, and millions of people will be left destitute, unfortunately. So as Lynette Zhang always says, the only monetary shield worth having is a metal, gold and silver. The paper is not a shield, as Lynette said. So I'm protecting myself with precious metals. I'm trying to avoid paper like the plague. That's my opinion. It's up to you to decide. If you enjoyed this video, make sure you hit the like button. Think about subscribing to the channel if you haven't yet. Make sure you hit that little notification bell above to be notified of all my new videos. Please share this video far and wide. And you can also follow me on Twitter, Facebook, BitChute, Steemit, and DTube. I wish you all a great day. Take care. Bye.